What's up, Squares? Harold Perkins here, and today I want to talk to you about some actual exciting news for first-time homebuyers. The Federal Housing Finance Agency, or FHFA, has recently just announced that they're eliminating the LLPAs for first-time homebuyers. Nice. You probably know the FHFA by the more commonly referenced entities of Fannie Mae and Freddie Mac. Let's start with what are LLPAs and why are they important? It stands for Loan Level Price Adjustments, and they're the fees that lenders charge to offset the risk of lending money. They're essentially an additional cost to borrowers that can add thousands of dollars to your mortgage through either higher costs or a higher interest rate. It's important to understand LLPAs because they can impact your monthly payment and add additional costs to your home.
This is your down payment, then here's your monthly, and there's your weekly.
And that's it, right?
Yep. Oh, then after your final monthly payment, there's the routine CBP or crippling balloon payment.
But that's not for a while, right?
Right.
Sweet.
Have you ever asked a mortgage broker what interest rates are today? Of course you have. And their answer is usually something like, it depends. Well, LLPAs are why it depends. For example, someone with a smaller down payment might pay a higher interest rate than someone with a larger down payment. Okay, that makes sense. But what about somebody with a smaller down payment and a lower credit score? Yeah, that's right, a higher charge on the LLPA. Okay, what about a smaller down payment with a lower credit score on a manufactured home in a condo subdivision with an adjustable rate first mortgage and a second mortgage carryback from the seller on a house that's going to be rented? You just hit the LLPA mother load. So that last example is extreme and probably not possible, but more realistic scenarios can be very expensive to a home buyer. Somebody with a 680 credit score would pay almost $5,000 more in costs to get the same interest rate as somebody with a 740 credit score. That's LLPAs. It would be almost $15,000 more if their credit score was 620. The average credit score for someone in their 30s is 672. The average age of a first-time homebuyer is 35 years old. So what does all of this mean? It means that the average first-time homebuyer is paying massive amounts of money for their mortgage compared to the more established homeowner with the more established credit history. For most of us, it costs money to get in the game.
For our purposes, you might just as well visualize a large bag of money. This individual wants to buy your house today for cash.
Cash.
Cash, I know, in this economy.
So why are LLPAs being eliminated for first-time homebuyers? Well, sometimes the government gets it right. The FHFA recognizes the challenges that first-time homebuyers face when they're trying to purchase a home. Home prices and a competitive housing market make it difficult for first-time homebuyers to enter the market. By eliminating the LLPAs, the agency hopes to make home ownership more accessible and more affordable for first-time homebuyers. FHFA Director Sandra L. Thompson says that the move is to promote sustainable and equitable access to affordable housing. In other words, your bachelor pad now has a better chance of looking like this instead of looking like this. But why do first-time homebuyers need the help? Well, let's look at my home state of Arizona in 2022. 31.2% of all home sales were to investors, to people who are not going to live in the property. And by investor, I don't mean the everyday working person just trying to build up their retirement through real estate. I'm talking about the enormous institutional investors who buy up properties by the dozens or hundreds. These are companies like Welltower, Starwood, or Blackstone that own billions of dollars worth of residential real estate in the US. These billion-dollar companies are not going to bother negotiating with a seller over closing costs or a new water heater. How can first-time homebuyers compete with that? The game is rigged.
This game is rigged, man.
But there's hope for some of us. So who qualifies as a first-time homebuyer? Well, obviously somebody who's not owned a home before in the past, but fun fact, you don't have to be a first-time homebuyer to be a first-time homebuyer. Yeah, that's right. The definition of a first-time homebuyer is someone who has not owned a home for the 3 years prior to their loan application. So let's say you sold your home in February of 2020 because you were pretty sure the world was going to come to an end due to COVID. Well, good news, the world didn't come to an end. Also, you are now a first-time homebuyer again. Nice. But let's say that your mom put you on the title to her house because she thought it might be easier for you to help her out as she grew older. Good intentions, but you are no longer a first-time homebuyer because you are currently on title to a property. Even though you didn't buy it and you've never made a payment or anything, the fact that you're on title means that you own a house, so you are not a first-time homebuyer until 3 years have passed after taking your name off the title to that house. There are also income restrictions related to the waiver of the LLPAs. This is designed to help the people that actually need the help. Your qualifying income cannot exceed 100% of the area median income, or AMI. The AMI is published by both Fannie Mae and Freddie Mac, and you can look up the AMI for your area at this website. In most places in the US, you will find that the AMI is $88,800 per year. But of course, there are some parts of the US that are considered high-cost areas. In those high-cost parts of the country, a higher qualifying income is allowed. So make sure you check your area's AMI if you make more than $88,800 per year.
Everybody tells you they hate the Upper East Side, they want to live on the West Side, but believe me, when it's resale time, the East Side moves all the time. I mean, what do you got on the West Side? Sean and Madonna, trust me.
The LLPA waiver applies to qualifying income, not your household income, so I want to draw a distinction between the two. So let's say that your salary is $88,000 per year and you would qualify for your loan on that salary. But your spouse also has a salary of $50,000 per year, which would kick you over the AMI for your area. Well, just don't use your spouse's income to help you qualify for the loan. You already qualified on your own salary. Yeah, that's right. If a particular income is not used for the qualifying, then it does not count against the maximum income allowed, even if that person is married to you and is going to live in the house. Here's another example. Let's say you're single and you have a salary of $80,000 per year, but you also receive another $20,000 per year in bonuses. But you qualify for the house using just your base salary. Yeah, that's right again. You get the LLPA waiver as long as you don't use your bonuses for the qualifying. So to be clear, you can't decide to only use a portion of your salary. If your salary is $100,000 per year, you can't choose to only take credit for $80,000 of it in order to get the LLPA waiver. But you can exclude the extra parts of your income beyond your salary. Things like bonuses, commissions, or spouses. What I've just described about excluding portions of your income only applies to qualifying for the LLPA waiver. Other loan programs that have income restrictions may require that all household income is considered and not allow you to exclude portions of the income. Check with your lender for your specific scenario. The elimination of LLPAs can make a big difference for first-time homebuyers. By reducing the cost of borrowing, first-time homebuyers can potentially qualify for a larger loan, making it easier to qualify to purchase a home. Additionally, the lower monthly mortgage payments can make it easier to manage your finances. Home ownership has always been the American dream, but the ever-increasing home prices, costs, and fees have made it more and more difficult for first-time homebuyers to get in the game. And while this move by the FHFA is not going to solve all of the problems around housing affordability, it is a fantastic first step, and you need to get on board if you have not already. If you have any questions about LLPAs for first-time homebuyers or any other mortgage-related question, message me or comment below. I'll answer your question like an underwriter, either approved or denied. Later, nerds.